Good afternoon. This is Randy Taylor with OA1 Trading, OA1trading.com. We are excited to present some questions that have been asked about a specific trade that we had advised going into the close Thursday ahead of the jobs report Friday. And just to give you a quick background, I've been in professional trading for over 30 years. I've sat at the stock exchange with the multi-billion market makers and the institutions. I have friends in that. I've been on the Chicago Board of Trade, and I have made a lifelong study and practice of understanding what drives markets and how to utilize technical and fundamental reports and statistics that are shown on our price action in order to make successful trades. There is no claim to being able to be a magician and understanding bottoms and tops. However, we have already shown a tremendous success in being able to spot bottoms. Whether they're the bottom or just a bottom is something that can be debated. What can't be is that we have successfully for years been able to identify bottoms and identify tops. And we do that with technical analysis. And we'll go into a little bit of that in terms of the setup of this trade that we're going to look at. So we've had a period of time here of pullback, which, by the way, we started our service about right here. and you can imagine starting a trading service and immediately having nothing but downside trading that you have to do, or looking for bounce opportunities from an oversold ATR3 minus type of trade. So what we had advised to the macro level, because we have traders of all sizes, we have some very large, wealthy members, we have very small accounts that are looking to learn and build their accounts. The macro message to the smaller accounts was sit on your hands. Just don't do anything. And that message has been consistent all the way through this period of time, waiting for us to find a bottom. Now, there were two times during this phase where we did make advisories to basically buy large, big trades, and that was right here, and it was right here, and we caught both of those bottoms. They were technical. Frankly, one of them was probably one of the easiest ones I've ever had the opportunity to trade, and so we were able to trade that very large. But now what we have is, everyone's been watching this, I know, is this macro support level, and we drop below the 200 moving average. And that's not ever, on its surface, you're always concerned when you see the markets drop below a 200. But you're much more concerned when it drops below the 200, when the 9, 20, and 50, which are represented up here, are down below it. So until that were to occur, this is more going to be looked at as a demand area, not a supply zone. And so here's what we were watching on this level. This was the ES futures model showing what was happening, and that is it would drop down and it would always hold these bases. And so we had a pretty good read on where our support structure was. We had already given advisory for way back when that we were looking at the break of 4290 area to present some massive opportunity from sell-offs. It clicked this day, and the moment that clicked below that 4290, down it went. The next day it tried to make a push up and went down and then pushed up to the midline, kind of a 50% retracement, something that I call Model T. And then the next day again, no ability to trade above, but yet it held in a zone, a tight zone. Well, this was the day then that leads us into our jobs report Friday. We had traded these tight ranges with a put call strategy similar to the one that I'm about to describe. But on Thursday, we had exited that put call strategy, and what we advised our members to do is to buy a 427 call, because we were closing about mid-range of the top and low. We were about in the middle, and that's about where you would think going into a critical report where the markets are going to end up. And sure enough, we did end up close to that. So we advised to buy a 427 call expiring on Monday. This would be tomorrow. And a 421 put. And again, expiring Monday. Those cost just over $1 for each direction. We further advised that for every 10 calls or puts that you purchased, you bought an additional put. So if I bought 10 puts, I would have 11 and 10 calls. If I had 20 calls, I would have 22 puts. And the reason, I'll explain that in a moment. So this was the setup. This is what we advised. This is how we were going into the close, waiting for the jobs report. Here it is on SPY. Okay, so 427 would be up here, and then 421 down in here. And so we were positioned and ready to go for our trade. We also were paying attention to this 15-minute interval, and you could see the respect that it had all the way down. But coming into the jobs report, you notice that it had broken out above. Technically, that would be read as bullish. Doesn't mean that there's other confirmation that we look for and look at. But we do see this as a bullish signal. A lean, basically, for the macro market is the preparation for moving higher. That said, we anticipated the report would be received with volatility, both because of where we were structurally and the potential to either break it down and have a massive sell-off or to rebound. Again, I don't claim to be able to tell you ahead of time which one it would be. I'm here to tell you that OA1 disciplined trading service allows you to beat it regardless. We anticipated this volatility and we got it. The report came out. The SPY came below 421. We had bids, something that we do as part of this strategy. We don't just have this put call and just see what happens. We are strategic in how we approach this and anticipating a volatile move, almost a correctional type of a move to the mean. We expected to see the testing of these lows. That's part of the reason we took the strike that we did. But more importantly, we anticipated it going below that strike. What that allowed us to do is purchase shares against our put position. So we had no risk on those shares of SPY that were being bought. And now you can see the intent of having an extra put position, because the anticipation is either the markets are going to fold, which would go lower, and I want that extra one, or if it bounces, I wanted that extra one to be able to buy an extra level of shares. What we advised is 30% purchase of shares against your puts. So for every 10 puts that you would have, 11 in reality, but I'm going to use 10, you would buy 300 shares. And the next part of our strategy was to look for a move up $1. Our puts cost $1. And so now what we're doing is we're going to peel off $1 profit on the bounce. Well, this was a special morning because members were greeted with a bounce above 421, not once, and then coming back down below 420.50, not twice, and then back down below 420.50, but 3 times. Pre-market, we were greeted with opportunities to buy and sell for $1 profit our additional purchases of SPY shares. The third time that it comes down, we buy, and then the market's open. We make a push move up immediately and then come back down. And so we get our sell in, and we didn't make another purchase at that time because it did come down and hit 421. But if you have a 421 put, I don't want to be buying shares at the money or outside. I needed it to come back below again to buy. But we still had 20% of our long shares against all of our positions. So if you had 50, you had 1,000 shares of SPY. You also trimmed on the pushback after the market opened, and now you can trade those options. The reason why I apply the strategy of buying shares against an option is because you don't know if it's going to be up here by the open or if it was going to stay somewhere down here and it's still above where it was in the pre-market. That's why we buy shares, plus we're utilizing the leverage to own a long position with zero risk. The markets were very friendly to us because it came back down to 421 and we could trim out our put position and maintain enough puts to cover our long shares at this point. Well, the markets began a rally, and once we spotted this technical break at this point, which if you extend this line, I'm not going to go and show this, but if you saw this happening in real time, you would have known that the markets are going to rally. And so we were buying multiple different stocks at the same time, but this was our primary trade going into the moment. So here was that post-market open when it dipped back down into 421. We traded this one as well, the ones pre-market, and we peeled off those dollars. This one we did not buy, and we were immediately greeted with success as the markets broke and started its trend move. And you can easily spot when an institutional program algorithm is being run, and that's exactly what occurred. And so these present no fear when you recognize it or are aware and have experience of knowing an algorithm is running. These minor pullbacks are of no consequence to your overall trade. The market pushed all the way back up here to 429. We made the determination to eliminate our shares. Again, this is a trading service. So we took our profits on shares and we exited our total, any remaining puts or any calls, take the profits, book the profits. You're above 427. These had come all the way back and now we're very profitable. So we exited that trade, managed our other trades, and we're waiting to see an opportunity. What we found was this pullback zone was a perfect opportunity to apply another put call strategy for this week, which would have been next week on Friday. And what we advised is to take a 431 call and a 425 put out to next Thursday. The anticipation was we had talked already about 431 being a key area of resistance. I'm going to go back here and share that this candle right here aligned with this. This was our target of 431. This is 431. This is why we selected it as our initial or as our secondary level after we had profited on the 427s. So here we are coming and buying that put call and layering another one. Now that we've successfully traded, we did a 431 call and a 425 put. Again, splitting the current price. What ensued was, again, fortunate, and that is the algorithm had been turned off, but then began again. And it began buying again, and it was a short squeeze, very, very controlled, very tight on these ranges, moving the stock up above 431. So even though these were out to next Thursday, we were greeted with being in the money on Friday, literally, an hour or so after entering this new trade. What we advise at that point is to trim a small portion of the calls in the money and also to short up to 30% shares against your remaining position. Similarly to what we did here, because now we're in the money, I want to basically have the market makers right where I want them. And that is if they want to pull back into the mean, especially if it comes into the 425 level, I've now got a short all the way into my put. And I can then regulate around my put how I want to trade that. Do I want to hold the short shares? Do I want to exit the puts? Do I want to keep a portion of the puts to protect me if I want to go long? that's the decision that we can make at a later time. But at this point, we're sitting on short shares, and lo and behold, sometimes things happen over the weekend. You have the Middle East issue, everything blowing up out there, and people are thinking that the markets are going to have a really bad open on Monday. Well, we are in a catbird position again because of our strategic approach to trading. That is the essence of the put call strategy. I want everyone to recognize that understanding where to place your strike prices and then how to attack those when they come into the money are uh, paramount to being successful with this strategy. And that is all I have today from OA1trading.com. And the D, again, stands for discipline. Check us out. Love to show you how we do things. All right.